I am Justin Fraser here with DeRosa Group. Happy to share with you guys today, be with you here to share with you on Cash Flow Digest. Great guest, really excited to get into share with you some tax saving strategies with our CPA, the guy, the man, the myth, the legend, Jason Dubnik, the man who does all of our taxes, our tax strategies, the man who helps us with every one of our entities, which is many different entities, all the tax strategies for us, for our investors. Let's bring on our guest, if we can bring him up, Mr. Jason Dubnik. There he is. Jason, how are you today?
I'm doing great. How are you?
Doing great. Jason, please introduce yourself here.
Great. So my name is Jason Dubnik. I am a CPA. I've been a CPA for almost about 25 years or so, and specializing in real estate taxation. Really kind of that background for myself started when I became an accountant, and some of the first few returns I did were real estate investor returns. And I was always so fascinated by, how efficient from a tax standpoint real estate investing is, and that actually segued into myself becoming an investor as well, because I said, look, I'm seeing how all these real estate investors are doing so well. I said, how can I not be involved in it? So that's actually my background. I've actually been both an investor and a CPA for, like I said, going on about 20 years. And I think that's helped a lot with a lot of strategies that I myself have wanted to get familiar with as both an investor and an accountant. So, but that's my background.
It makes a lot of sense. Yeah. And sure, you see your clients having these big deductions, and it's like, how do I get a piece of that, right?
Absolutely.
We use at DeRosa, we use Jason for all of our entities, and Jason's firm is top notch, and the strategy is impeccable, and then of course, all the different returns for all the different entities that we have, and so it's very comforting for us to know that all of our books and all of our entities are covered by Jason's firm and that we're in good hands there. So knowing that Jason's got that background and experience with his firm and the people he's got working with him is excellent in that background. So definitely, very big endorsement from myself and from the DeRosa Group here, and shout out to Jason. So really glad you could join us today. I know we first started talking about this, I think it was around January, and you said, I want to talk to you about this, but I can't do it until the summer because the first half of the year is just a very, very busy time for me. So I wrote you down on my whiteboard, and you said maybe July. And so that's about, this is that, and so we've been waiting patiently to get this on the book. So I'm really excited that we can talk about it. But let's start sort of basic, and we'll work our way up from there.
Sure.
Because we've got all sorts of different levels of folks watching this here. But let's start with a few easy ones for you here, which is, what about real estate? Why is real estate such a great investment from a tax perspective? Why does the government incentivize real estate investors so heavily? What about it is so attractive from a tax standpoint?
Sure. So I guess a couple of points I would say that are really significant when you compare real estate with other types of businesses is that, one, just in general, the idea that it's considered a passive investment with the IRS. And really what that idea means is you do not pay payroll taxes on profits that you generate from real estate. So comparing that to any other type of business, a consulting business, a restaurant, anything like that, it's considered to be subject to payroll taxes, and that's above and beyond income taxes, and that can be pretty significant. Again, every situation is different, but potentially you might be talking an extra 15% tax rate on top of income with other businesses that real estate does not have to worry about when you're a landlord. Now, there are certain types of real estate investing if you're involved in construction and flipping, things like that. There's areas that it might be subject to, but for the most part, people who just buy, invest, buy and hold real estate, you are exempt from that payroll tax, which is significant. Another major reason why real estate is significantly better from an income tax standpoint is the idea of depreciation. Right, depreciation is huge. It is basically it's a phantom expense, right? So when you buy a property, regardless of how much you put down on it, whether you put down 100% or zero or somewhere in between, you're still getting a significant amount of depreciation. And like I said, that is a phantom expense. You are not actually spending the money, but you're getting a tax write-off. Now, it is a timing benefit. So ultimately it will even itself out in the end, but depending on the type of real estate business that you're involved in, if you structure it properly, in the future when eventually you have to kind of pay those taxes back. Hopefully you have another deal that replaces that deduction, and you can theoretically keep this concept going where, and basically it can accomplish the idea that you can generate actual income off your real estate properties and not have to show a profit from a tax standpoint, which is phenomenal. There's really very few things in the tax code that allow you to actually make money but not pay taxes on it. And the last thing I would say is leverage. I mean, leverage is another great vehicle where basically being able to get at the equity in your properties, and loans are not taxable income. There are some exceptions, but for the most part, being able to cash out refi on your property, those are non-taxable dollars. So just another, really just being able to avoid certain taxes, getting access to your dollars without paying taxes. It is such a powerful vehicle. And lastly, I would say, which is going to kind of segue into what we're going to talk about today, is, when ultimately you're looking to exit real estate and you have some gains, real estate offers the ability to defer those taxes like very few other asset classes
Yeah.
have. So
All great points. And, Jason, probably some of the folks who are watching this kind of get that and have read some books about that and understand most of, a good bit of that. But maybe some of the folks that are watching, they maybe call their CPA one time a year, which is around tax time, right? And they say, hey, here's my docs, let's file taxes. I know that you and DeRosa, we talk on a much more regular basis, and we we get a new project up and we kind of talk and we plan and we plan on a more frequent basis. Let's talk in terms of, before we get into some of the strategies that we're going to talk about, but let's talk about sort of a solo investor. Maybe they're working full time, maybe they're just kind of starting out their business. They've got maybe a small portfolio. How should they be talking to their CPA? How often? What kind of things should they be talking about? How can we be more active and have some foresight with our CPA? What does like active planning look like? What are those conversations like? And what are some of the benefits that can happen with some active planning versus sort of being reflective only at tax time?
Sure. So, first I would say is obviously getting into the business is making sure that your CPA is aware of what, any kind of new business venture, right? Whether it's buying real estate or starting some kind of a business, how you set up your entity is a big factor, right? I mean, some of the things that may not seem so complicated until you realize at the end of the year when maybe you did or didn't do something the right way. And now at tax time, it's a messy situation. But things like what states you're operating in, right? If you live in one state and you're doing business in another state, that is a pretty complicated tax situation that you need to be prepared for with the type of entity you're creating. Do you have partners? How long are you planning on staying in these types of investments? So all those things are really, really important to make sure that you get guidance on, rather than just, kind of simply saying, I want to do a business. Let me go create I'll go on legalzoom.com, create an LLC. And those are the types of things that usually the accountants kind of 6 or 8 months later saying, what did you do? Now we have a whole lot that we have to unravel and try to fix, because what you did is not conducive to what we now have to file for tax purposes. So, most important thing, like I said, with any type of business venture, always good to have that conversation with your accountant, let them know what you're planning on doing. There's definitely some guidance on the type of entities that you should be operating through is very, very important. And, really, like I said, making them aware of the type of business you're in might require some type of, kind of periodic tax planning. Certain types of businesses, they might have that self-employed income that might result in a significantly higher tax rate than you might be used to paying, right? I mean, most people that are going from employee to self-employed, they never really had to worry about taxes at the end of the year. Typically, all the taxes were withheld from their paychecks, and at the end of the year, you had a refund, you had a small balance due, but it was close enough. You're self-employed and you're not paying those taxes in, that's a pretty hefty check you might be writing at the end of the year. And it's good to know that it's good to be prepared for that, to avoid kind of late payment penalties, things like all those things. So that's what I would say. I say the key is always call the accountant before something big happens. I mean, this is, again, the biggest issue I kind of run into is, with my clients is, they call me the day after they sold their property or the day after they generated a big tax event, because at that point it's too late. There's nothing we can do besides I can tell you how much to set aside to cover the taxes. But if you're looking for tax strategies, it has to be done prior to the big tax event. And that's really the key is, if I don't know that you're involved in some business venture, how
That
can
makes a
I
lot of
advise you what
sense.
to do when you're ready to sell it?
So be proactive, reach out ahead of time, and make sure that you're actively talking to your CPA throughout the year. We wanted to get into the deferred sales trust a little bit. So let's take this one slow because this is a newer concept. So let's get into a little bit. So I'm going to just let you take it away. Tell me, we typically we sell a property, we have a capital event, right? So I sell my property and I have capital gains, which means I'm going to have to pay taxes on those gains, and that's a big check I have to write. You're saying, hey, there's an alternative. And now a lot of folks are familiar with an alternative called the 1031 exchange, in which I can I can put those proceeds with an intermediary and find a like kind property and go buy. So if I sell a 10 unit, I can go put my proceeds with an intermediary and go buy a 12 or a 15 unit property and go take those funds and roll them in, and I don't have to pay the capital gains taxes. You're saying there's another option here besides the 1031 exchange where I do not have to pay the capital gains taxes. So can you take us through that option here?
Yeah. Absolutely. So just to kind of touch on your point there, 1031, which I'm sure a lot of investors are familiar with, it is a fantastic tax deferral strategy. There does come with some downsides, and that's where, this is an alternative strategy that can be used. There are certain limitations. That's where there is an alternative strategy that could work effectively for real estate investors as well. So the concept that I wanted to introduce, I guess, to everybody today, it is called a deferred sales trust. And essentially what it is that it acts as a middleman when selling really any kind of capital asset. That covers real estate, businesses, ownership interests in LLC. So there's a lot more flexibility with utilizing a trust versus a 1031, which really is very limited in the sense that you can trade, like kind assets for like kind assets. So you have to sell, a piece of real estate for another piece of real estate. You cannot use it for businesses anymore. You can't use it for a membership interest. So again, depending on how somebody owns their investments, this is something that gives a little more flexibility when selling out of one asset class and then being able to invest in other ones. But so that's the general kind of, I guess, kind of the advantages, I guess, how it would compare to a 1031 exchange. But the way the deferred sales trust simply would work is that when you're looking to exit one asset, and the idea is that you're looking to roll those dollars into something else. The 1031, again, there are timing limitations, which may not be ideal, right? I mean, you may have a great buy, you're ready to go, and you want to get out of the asset, you want to sell the property, you've got a great price on it. But for the 1031, you have to be able to identify that new property in 45 days, and you have 6 months to close on the property. Unfortunately, what I've seen a lot is you sell the property, you hope you're going to find that new property to get into, and it just does not work out. And then you're forced to either, get yourself into a new property that is not ideal for you, or you basically end up having to pay the taxes on it. So not ideal through a 1031. So with a deferred sales trust, there is no time limit. That's kind of one of the significant advantages of it, is that when you sell your asset, the money is parked in an account and it's ready to go for you whenever you find a new deal. You can purchase real estate, you can invest in businesses, you can invest in syndications, and until those investments come up, the money is sitting and it's simply invested in regular mutual funds and T-bills, whatever you want. It's sitting there ready to go and waiting for you. And that's the significant advantage, is that there are no time constraints, which gives it much more flexibility, that being able to get out at the right time, but you're not quite ready to get into something, and that could be 6 months, it could be 2 years, it does not matter. So
All right, so let's take one step back here. So I'm selling my
sure.
property. I decided to sell this property here. I'm in one of our properties today. I decided to sell this one to on the open market. Right, we sell it. The proceeds from this property go not to me, but to this trust. Right? Is that
Right.
how that
Right.
works? And so
Yep.
the proceeds go and sit in that
Correct.
trust. So I've never actually received those dollars. Right? They go straight into the trust.
Correct.
So I'm never realizing the dollars of those sales. So now I'm not having a taxable event because the dollars are going into the trust, right?
Correct.
And then that
Correct.
trust, you're saying, can reinvest those dollars into something else,
Mm-hmm.
and does not have the trust is not going to have to pay taxes on that at this point either. Is that right?
Correct. So basically, what we're talking about is the deferral strategy is very similar to it's holding back a mortgage, right? If you were to sell a property to the end buyer, and instead of them paying you, in cash right up front or getting a mortgage, they ask you to hold the note back. right? What that is, if in tax purposes, that's called an installment sale. And from an income tax recognition standpoint, you only have to pay the taxes as you receive those dollars on the note. So whether that's over a 2-year period, a 10-year period, 20-year period, whatever you guys have negotiated, you can defer the taxes until you receive those dollars. So it's a very, installment sales it's been around for a very, very long time. It's a proven tax strategy. The advantages are you can defer the taxes for some time, but again, it also comes with certain disadvantages. Mainly is you're still tied into the property and to the buyer, right? And you're relying on that buyer to effectively operate that property or that business and continue to make those payments to you. That's your only collateral really is the business or the property that you just exited. So worst case, if they stop making their payments, now you have to take back the property, but you also have to deal with, well, what did the buyer do to that property in the time since I sold it to them? So you may not necessarily want to do that. You most likely in these types of cases, if you're ready to sell, you want to be completely done with this property. You want to be completely done with the seller. You don't want to have anything to do with it. So that's the typical drawback with an installment sale. What this deferred sales trust strategy does is it basically accomplishes the tax benefits of the installment sale without having to deal with the buyer, right? So let's give an example here. Let's say you have a property you're ready to sell. You've negotiated a sales price with the buyer, and prior to the sale, you establish this deferred sales trust. So instead of selling the property directly to the buyer, you sell the property to the trust. And the trust completes the transaction for you with the buyer. Very similar to how a 1031 exchange works, where prior to the sale, you simply sell it to that intermediary company, and the intermediary company completes the sale for you. So the idea here is that while the funds, right, so in this deferred sales trust situation, the buyer, they've written you the check. They're out of the equation. You no longer have to deal with the buyer, the property. It does not matter. You now have the actual cash sitting in the deferred sales trust. But the idea is that until you withdraw your funds from the trust, you don't have to pay the capital gains tax because technically you have not received them yet. They are sitting in this account, and that account is basically, those dollars are there for your benefit, but you have not received them yet. And that's what allows you to defer the taxes. And what's different than the 1031 again is that this deferred sales trust does not have any of those timing rules or requirements that a 1031 exchange has. So it's basically the contract is between you and the trust. So while those funds are sitting in the
So
trust,
we actually
now you have the
sold the
option of
property to the trust, and the trust sold the
correct.
property sort of at the same time, right?
It right.
Almost like
This
a
is all within about within a few day, 1 week process prior to that. Basically,
yeah.
the trust just simply completes the sale for you. Yes. So
Got it.
while those
Got it.
funds are sitting in the trust, now you have options of what do you want to do with these dollars? The trust has to invest these dollars on your behalf. And this is where we get into the idea of, well, if you want to reinvest in other properties and other businesses and other LLCs, you can do that. Those are all assets that the trust has the opportunity to invest in for you. These are still your dollars that the trust basically has to repay you at some point, just like had you held the note for the buyer, same deal. They would have had to repay you these dollars. The trust has to repay you these dollars. But until that time, you're basically using tax deferred dollars to invest in. So in a simple example, and this is really the beauty of utilizing tax deferred vehicles, if let's say you sell a property for $5 million, had you paid the taxes, maybe you would have paid 2 million, right? And you have 3
Mm-hmm.
million left to invest with. Using tax deferral strategies, you now have $5 million to invest. So the idea is that you're using the IRS's money to invest in. You still owe them the same $2 million, whether you pay them that today or 10 years from now. The idea is that you got to use their money to invest with. So
And because you're writing the note between yourself and the trust, you can write that note however you want it to be. You can structure it however you want
you
it.
structure it right. There are basic rules that you have to follow to make sure that it's a legitimate note. You're getting paid interest on your
Sure.
money just like anybody else would. But that's the beauty of it, is that how that note is structured. Do you want to get your money back every single year? Do you want to do interest only for a while? You can extend these notes. Again, it's basically, you look at it as it's basically a private contract between you and the trust, just like you would negotiate with the actual buyer. Same way you would negotiate the trust documents, the note with the trust. So however it works out for
Got it.
you, if you're looking to continue to invest, you want to get out of the real estate game, you want to get out of the investment game and just want to collect the check for the rest of your life, you can do that. But if you want to put that money back into work, into properties, into businesses, you have that flexibility as well.
Got it. Okay. What are some of the hangups here, or some things that we could get ourselves tripped up on if we're thinking about moving into a deferred sales trust here?
Yeah, so I would say, I mean, the one, I guess, as a drawback when you comparing it to a 1031, the one, I guess, the one negative side of it is that you cannot use 100% of the funds into another real estate deal. It is capped at 80%. And I'll tell you, there is,
Okay.
the reason for that. Again, it may not be so bad because you say, listen, I get 5 million, I can put 4 million back into real estate. The other, really, it just means that some of the funds have to stay liquid. And the reason for that is that they have to stay liquid because the trust has to pay you interest. That's how this works, is that the trust owes you this money and it has to pay you interest. So if you roll all the proceeds into a piece of real estate that is illiquid, right, and you put it into investment and the investment should generate a nice return, but let's say, there's some vacancies, there's some capital improvement to be done, and then all of a sudden that property cannot pay you your distribution this quarter. Well, now the trust can't pay you its interest.
Yeah.
And that's the problem. So 20% has to stay back at least in liquid investments to be able to, and again, the goal is for you to be able to pay yourself that interest. So that's one caveat, is that you cannot roll 100%, which again, may not be the worst thing in the world. You want to keep some of it liquid to be able to pay you your interest. So
Okay. Got it.
again, I'd say depending on, the assets that you're looking to, does every asset that you're selling qualify? Would it be a good candidate for the deferred sales trust? Maybe, maybe not. It really, every situation would be different. I'll give you an example of, let's say, if you're selling a piece of property or a business where you have a very high cost basis, right, where your gain is not going to be very much. So you're walking away with $5 million from the sale, but let's say your gain is only 500,000, right? Only 10% of it. That may not be an ideal scenario because you're really only deferring a small portion of gain, but you're going to be locking up a whole lot of money into the trust. So there's certain cases like that. But honestly, in a case like that, I mean, I guess you could still do a 1031 exchange if you wanted to, but in the same case, you'd be locking up a whole lot of tax-free dollars that you may not want to do. But for the most part,
Right. And so you
um,
think proceed size, where does this really make sense? What size deal makes sense here?
typically, I would say anywhere from a million to 10 million. That's kind of the sweet spot where the tax laws will work to your benefit. The minimal cost of setup to do it are warranted for something like that. But anything less than $1 million probably wouldn't look to do something like this.
So for those of you guys who are capital raising, if you have potential investors who are saying, hey, I've got a 1031 or my money's tight, I need a project, we could offer then this deferred sales trust where, hey, instead of the 1031 and the ticking clock here, let's potentially get your dollars into a deferred sales trust, and then you can invest that trust into a project when we have the right project for you. And so that's a great way that you could still invest with us without that ticking clock of the 1031, right? So, Jason, thank you. Really, really good information and probably just the tip of the iceberg here. But you are set up where if people want to get more information on this, then they can reach out to you, right? And probably deserves a much deeper one-on-one conversation. So how can they talk to you more? How can they find out more information from you and have that conversation?
Absolutely. And Justin, and touching on your point there is that I am yet to see a situation where it's so cut and dry. Every situation is so unique and there's always some kind of a moving part to it. So this is definitely not a cookie cutter strategy, but that's also one of the benefits of it, is that it really can work for so many different scenarios. But everybody I've ran into has some kind of a special quirky situation where you really need to talk through with somebody that understands the strategy to see how it could work effectively and efficiently. So but yeah, like I said, my accounting practices, we're located in New Jersey. We deal with clients all over the country, and I can be reached at my telephone in the office here is 732-625-3752, or you can email me at jason@dubnikcpa.com.
So if you guys are considering a deferred sales trust, Jason Dubnik and his firm are set up to talk you through that and all that. I'm not letting you go yet. We do have a few questions from LinkedIn, so I definitely want to make sure that we
Absolutely.
get into that. If you guys do have questions, we do have a few minutes for Q&A here. So a few questions from LinkedIn here, Jason. For real estate investors, obviously tax saving strategies are huge for the bottom line. So what do you see, as you review real estate investors kind of tax returns sort of across the board? What's, if you can generalize, like a common overlooked opportunity that you see that maybe people are making mistakes or they're just missing an opportunity that they should be taking advantage of?
You're talking about primarily for real estate investors?
Yeah, yeah.
Yeah. Yeah. So I guess common scenarios that I found, and again, some of this may not necessarily just from a tax standpoint, but just from a general kind of business practice standpoint, is a lot of times entity structure. That seems to be a big issue sometimes. Where, like I said, I think I touched on it before I lost the signal there. So it's people not setting up their entities the correct way, especially when they get into investing in different states. There's so much complication that kind of comes into that sometimes kind of it's not just a matter of setting up an LLC and going and doing business. It's you really have to figure out, where am I going to be operating? How should I set up? What's going to not create multiple, tax filings in different states? That's a big factor that I find a lot with investors, especially now that it's easy enough to just, you're in one state, but you can invest anywhere you want through different investment groups, right? It's not that I'm just going down the street and buying that property. That's a little easier to kind of plan for, but different states are a big factor. I mean, as far as other just tax strategies, again, depending on the size of the size of the property, where some of these things can benefit you, but depreciation is really huge, knowing that there's different types of asset classes. So when you do improvements on your building, not everything doesn't fall into one bucket, right? Most depreciation is spread out over a very long time, and it takes a long time to get the tax benefit. But understanding that there's different asset classes when you improve on your building, and some things you can depreciate a lot quicker than other things, and it's giving you that. Again, we're just talking about taking the advantage of that tax savings today versus many years. So those, I would say,
That
would be
goes
a
back
couple
to
of the
keeping good records and keeping good records on where you're investing, and
absolutely,
how much are we spending on our carpets and our materials and
yeah.
and fixtures and everything else, so that we can then go depreciate that much faster than the other things that we depreciate over 20 plus years, right?
Like you said, buying a refrigerator or putting a roof on the building, they are depreciated at
Right.
different rates, and it's important to know that to make sure that you're getting your benefit quicker. So
Right. And that's just ties back to what we said at the top, which is, being proactive, talking to your CPA at the start of the project versus at the
yep.
end of the project, and knowing what to keep track of and how to keep track of these things, so that as you're going through the process, you're tracking the right data, and then you're able to take advantage of that come tax time rather than at the end of the project. Jason, we're getting another question here around, obviously tax law changes all the time, and then
Mhm.
obviously another election coming up, and every time that changes, there's a new set of tax laws, it seems like. So how do you stay up on the latest tax laws and regulations? Curious how you do it, and then how do you recommend that real estate investors like us, like the common person who is not, super CPA like you, how do I keep up
Sure.
on the latest as well? What do you recommend?
Yeah. So, look, I mean, when, right, we have an election coming up right now. Our current tax laws that we have right now were actually put into place under Trump's presidency before. There were really no major changes that were done under Biden's presidency before. So, but the Trump tax laws that were put into place are scheduled to sunset next year. So what that means, and again, this is how pretty much whenever tax packages get put into law, they are not forever. They are always, they expire at a certain time. And the idea is that whoever's in office at that time and whoever's controlling, like maybe they extend them, maybe they come up with new laws. So we do have about 1 year before there might be some major changes. Now, under the current tax laws, if they do sunset, we'll go back to kind of what was prior to those laws. So I would expect next year something's going to happen. Either the current laws will get extended, either for a longer time period, or they'll just be 1 year patches until they figure something out, or the whole thing gets thrown out and we get something completely different. So there's going to be some changes next year. In tax laws. I mean, and interestingly, when there's some discussion, there's a lot of when they pass some laws. Listen, I'm just like any other investor. In some ways, I'm waiting for the news to hit me. I mean, look, as a CPA, I have access to certain educational resources that once tax laws are kind of put in place. Look, I rely on those professionals to kind of package it all up and explain it in a nice in a format that then, and that's really how I go through. I mean, I pay attention probably more than the normal, kind of person to say, hey, what's potentially on the table? But usually, even when that information comes out, there's still quite some time before that actually becomes law. But then once it becomes law, now the challenge is, okay, let's see how they change the rules and let's see what we can do about it. How can we, use these to our advantage? What things do we need to prepare for? Sometimes when there's upcoming rule changes that, you have a little bit of a window before they happen, A lot of times this happens where it's like if you know that the law is changing on January 1st of next year, and let's just say, for example, capital gains rates are scheduled to go up significantly, that's an opportunity for people that were thinking about selling their property. Say, hey, if I sell it now, I pay this. If I wait until next year, I pay this. So that's kind of when we start scrambling and saying, hey, be prepared. If you were thinking about doing it, know that this is what's going to change next year. But yeah, it's going to be a little while. I would say about, at least a year or so until we figure out, who the next president is. And then it's going to be maybe another year or so before they figure out, do they want to change some tax laws, anything new goes into effect. So we have a little bit of time, but yeah, then once I get it, then like I said, I put the information together for my clients that I think it will be pertinent for. And that's when we start planning.
Yeah. Well, we'd love to have you back as some of those changes when they get
Sure.
announced and have you talk us through it. We'd love to have you break it down for us. But this has been
Absolutely.
incredible. Really, really appreciate you coming on. Thank you, everybody, for joining us for the questions. If you're going to take advantage of that deferred sales trust, Jason, let's do it again. The website or the firm name, do you want to, whatever you want to put up there, let's hit your contact information one more time for
Sure.
everybody.
Real simple. Let me give you the firm website is dubnikcpa.com. And then from there, all the contact information is right on there. You can reach me there. And like I said, contact the office. If there's a particular situation to run through, happy to kind of review it with and see if it's something we can help out with.
Okay, perfect.
Perfect.
And we got that up there, right there in the comments, right there. There you go, dubnikcpa.com. Guys, take advantage of Jason and his team. I know that we do. We put a lot of trust in Jason, and we love working with him and his team there. They are excellent, high quality folks, and really can't thank you enough for coming on and sharing this information here, Jason. Really appreciate it, and thanks so much for sharing your wisdom. So looking forward to having you back, and hey, enjoy your weekend. Thanks for coming
Thanks so
on.
much for having me. Absolutely.
All right, thanks. All right, folks, thanks so much again. Another cash flow digest in the books. Hope you have a fantastic Friday. Enjoy your long week. Enjoy your weekend. Maybe it's a long weekend for you. Maybe not. Maybe not. Hopefully, and we'll see you next week. Thanks so much, and have a great and profitable week. Are we still doing that? Let's do it. Have a great and profitable week. We're bringing it back. Let's go.